So it's important to understand that silver being such a small market, it's been very easy to manipulate. And they had to manipulate silver harder than gold because if silver ever got on hand, then gold goes. And if gold goes, then you have confidence breaking. And understand it, you were talking about derivatives. It's a zero-sum game in the OTC derivatives market where there's over $2 quadrillion worth of paper or contract. The problem with that, because it's a zero-sum game, if you have a huge winner, that also means there's a huge loser. And was that loss big enough to put the loser out of business? And if the answer is yes, then the loser can't pay the winner, which means the winner then becomes a loser also.
Right.
And that will spread across markets everywhere. That'll spread across credit markets. It'll spread across stock markets, equity markets. Interest rates will explode. That'll destroy the ability to carry real estate on debt. It's a seizure or a meltdown of credit is what we're facing. Yeah, there's always a chance because you used the word for a while. For the end scenario, mathematically, no, they cannot fix this. They can't kick the can down the road. It's here. It's now. They're using their old tricks. They've raised margin on COMEX, which they've done many times before. They raised the margins and then forced the longs out because they can't afford the margin. They sell. I think the other day, in an hour's time, they sold something like 20,000 contracts. I mean, that's a huge amount of silver, and that silver does not exist. Remember, it's 5,000 ounces per contract, which I think that number worked out to be about 1 billion ounces were sold. The world only produces 800 million, 850 million ounces collectively in a year's time.
Yeah.
And that's only $40 billion.
Yep.
The global production of silver, even at all-time high numbers of $52, $53, is only just over $40 billion. I think that's not really the right way to look at it. It shouldn't be concerning. If you're sitting on silver and markets close, I can't think of another asset that I want to have in my hands other than a loaded gun and food. I cannot think of any monetary asset that I would want in my hands other than silver if markets close. And I'm not dissing gold. Gold is for, that's your store of wealth, but you're not going to trade in gold. I mean, you're going to have a hard time with silver eagles or 1 ounce bars or 1 ounce rounds, silver rounds. You're going to have a problem getting change back. I mean, if you deal with a farmer and let's say you want 2 dozen eggs, how are you can't get change back, but a silver dime will do it.
So why is
I do want to talk about that.
Go ahead.
Let me just mention this because I've got a bunch of emails in the last 3 or 4 days. The wholesalers have really pulled their bids back on junk silver. Junk silver now, if you're going to sell it, you're looking at $2.50 or $3 below spot. The only silver above spot in North America are silver eagles. I think they're about like $1 over spot. But people are concerned that, oh my gosh, I'm not going to be able to sell my silver. Well, understand that when all this silver that's been sold, all this junk silver, that's been melted down. And of course, they've not made any silver dimes or quarters since 1964. So there is no more supply. And the supply that has existed, any of that's being sold, if you're selling it at $2 or $3 under spot, I guarantee you your wholesaler is sending that to a refinery and just picking up the 3, 4, 5% VIG and putting that in their pocket. Understand that can't go on forever. And also there are refiners now saying they're not accepting any more silver because they've been inundated and it's a physical process. It's not like pressing a computer key and boom, it's done. They actually have to refine it out. They've got to refine the 10% copper out if they want to get it to 99.99 pure.
Yeah.
So while right now it feels a little bit, maybe did I make a mistake buying junk silver? No. If you wait a month, 2 months, 3 months, and this is assuming the system continues and does not collapse, in the future, in my opinion, junk silver is going to end up holding the highest premium of any form of silver in North America because the supply is being wiped out. Whenever anybody sells it, it's being destroyed, it's being melted down.
Folks, I've been saying this for years. Silver is the Achilles heel of the entire paper system. It's such a small market that it's been incredibly easy for the powers that be to manipulate. They had to suppress silver even harder than gold, because silver is like the fuse on a dynamite stick. Once it ignites, gold goes next. And once gold breaks free, you're not just talking about a commodity rally. You're talking about a total collapse of confidence in fiat money. That's what they fear most. Now let's break this down in plain English. What we're really talking about is a derivatives-driven system, a global casino of contracts, promises, and leverage, worth, depending on how you count it, over $2 quadrillion. Quadrillion with a Q. To put that in perspective, the entire world GDP is barely $110 trillion. So this derivatives market is something like 20 times the size of the global economy. That's not capitalism. That's a ticking time bomb. And here's the thing about derivatives. They're a zero-sum game. For every winner, there's a loser. So when a massive position blows up, when one side of the bet goes bad, you don't just have one loser, you have a contagion. Because if the loser's position is so large that they can't pay the winner, then the winner also becomes a loser. The whole system freezes. You saw a taste of this in 2008. Remember AIG? They sold all those credit default swaps, insurance on bonds, and when the bonds went bad, AIG didn't have the money to pay the winners. So what happened? The Fed and the Treasury bailed them out with hundreds of billions of dollars. But here's the thing. That was child's play compared to what's out there now. The derivatives market today is much bigger, more interconnected, and more fragile. So what happens when one big player goes bust, a major counterparty, and the losses cascade through the system? The same thing that always happens. Liquidity freezes, confidence collapses, and credit dies. That means everything stops. Stocks crash, interest rates explode, and real estate, built on cheap credit, implodes. It's not just a market correction, it's a credit seizure. And that's what we're heading toward. The math simply doesn't work anymore. The central banks can raise margins, they can tweak the COMEX rules, they can suspend trading, but they can't stop gravity. This is the endgame. They're trying the same old tricks, raising margin requirements to shake out the longs, dumping massive paper contracts to push prices down. But it's not working anymore. Just look at what happened recently. In 1 hour, they sold 20,000 silver contracts on COMEX. Each contract represents 5,000 ounces of silver. Do the math. That's 100 million ounces, or roughly a billion ounces, traded in 1 hour. The world only produces about 850 million ounces a year. So in 60 minutes, more silver was sold on paper than exists above ground for sale anywhere on the planet. That's not a market, that's a con. Now at $50 per ounce, the total annual silver production on Earth is worth just over $40 billion. Think about that. Apple could buy every ounce of silver mined in the world this year with its cash reserves and still have money left over. That's how tiny this market is. And yet it underpins the entire electronics, solar, and green energy industry. So what happens when the physical market finally takes control? When someone says, I don't want a contract, I want delivery, that's when the music stops. The vaults are already being drained. There are reports out of India that refiners can't even get raw silver anymore. Premiums in Shanghai have blown out to record highs, as much as $8 above the so-called spot price. That's the real market telling the paper market it's lying.
I was going to say we can start with silver because that's where the financial system very well could end, is with silver. There's obviously huge tightness all over the world in silver. India has doubled the amount of ounces. Forget about dollars or rupees. They've doubled the amount of ounces they're importing. The bullion dealers in China have basically closed down and they're not selling silver. The one bullion dealer that is selling silver is selling it at $128 an ounce. Silver's gone into backwardation where the futures or where cash is higher than the futures. The lease rates have exploded. It's primed and set up for failure to deliver. And I can't stress enough how important it is for silver not to fail to deliver, because if it does, it'll immediately spill over to gold. And you get action in gold like we're seeing in silver, that's the end of the system. And I say the end of the system because confidence will entirely break. And the fractional reserve / fiat system runs 100% on confidence. And if you break confidence, and it goes back to what my late partner Jim Sinclair used to say, what is the value of a contract that cannot perform? And the answer is zero. And he posited that you could see gold futures at $10 offered, no bids, and $50 $1,000 bid and no offer, meaning people will not accept contracts because they know they're not going to perform. They want the real deal in their hand, than they did 40, 50 years ago. And we should talk a little bit about the two spikes in silver that we had previously to $50. 1980 with the Hunt brothers, and then 2011, the Hunt brothers. That was if you want to say that was vapor at the end. I mean, there was a huge spike. It was basically an intraday spike, or within a week's period of time. They did not stay at $50 for any real length of time. And then again, the same thing happened in 2011. We had the spike up. It didn't go through 50. It fell back, and then they smashed it. And of course, they smashed it in 1988 also. This time, I know it's not good to say this time it's different, but it is different. It's already different. You can see it. We've been over $50 now for a week, maybe a week and a half. But the thing is, we've gone through 50, and the buying, if anything, has increased. And the risk here is that the chart goes parabolic, and the blood in the water that the sharks smell is that there's not enough supply, and that that they can break these markets. So when I say break the markets, you've got too many longs demanding delivery, and there's not enough supply. And we're going to find out that both gold and silver have been fractional reserve markets where they counted on only 1 or 2 or 3% of the longs standing for delivery. It's been a process. This has been taking place for 2 or 3 years now. If you look at both gold and silver on COMEX, the first notice day, and I'll just use a number of 100. Let's say there was 100 contracts standing for delivery. Prior to a couple of years ago, 3 years ago, what would happen is you have 100 contracts going into first notice day, and by the end of the month, it might be only half or 25%. In other words, the longs liquidated, took cash settlement, and walked away. But what's happening now is you get first notice day with that same 100 contracts, and by the end of the month, you might have 150, 200, 250 contracts standing for delivery. So no longer can you count on first notice day being a big number, and that's going to shrink from there.
Let's pick up where we left off, because what's unfolding right now in the silver and gold markets isn't just about price. It's about the breaking point of a system that's been stretched past its limits. You can only play accounting games for so long before reality forces a reset. We're standing on that edge right now. When you look at the silver market today, it's a perfect microcosm of how the global financial system operates. Leverage piled on top of leverage, paper promises traded back and forth, while the actual underlying asset becomes almost irrelevant. We're watching a system that sells what it doesn't have, promises what it can't deliver, and counts on no one ever calling its bluff. But the world is calling that bluff. India, China, and even industrial consumers in the West are demanding delivery of real metal, and the cracks are showing. Remember, every ounce of real silver represents a claim that can't be printed. That's why they've had to suppress it so aggressively, because if silver ever broke free, it would expose the weakness of the entire monetary system. See, silver isn't just another commodity. It's the canary in the monetary coal mine. When silver spikes, it's not just signaling demand for metal, it's signaling a collapse in confidence. Because if people suddenly want to trade their paper claims for physical metal, it means they no longer trust the system. And that's what's starting to happen. Just look at what we're seeing with lease rates. The cost to borrow silver in London has gone through the roof, hitting levels we haven't seen in modern history. That's a sign of extreme tightness in the physical market. You don't get 30% plus lease rates unless the shelves are empty. In any other market, that kind of shortage would be front-page news. But in the precious metals world, they act like it's business as usual. Now, when I say this is systemic, I mean it. The derivatives complex that underpins the entire financial system is a web of interconnected liabilities. More than $2 quadrillion worth, according to the BIS. That's not an exaggeration. It's all interlinked. Foreign exchange swaps, interest rate swaps, credit default swaps, and the common thread through all of it is counterparty risk. If one major player can't make good on its obligations, that failure ripples outward like a shockwave. Remember what happened in 2008 when Lehman collapsed? That was a small taste. This time the stakes are exponentially higher. We've got governments, banks, and corporations all loaded to the gills with leverage. A derivatives blow-up in the metals market could easily cascade into bond markets, stock markets, and housing. Because when liquidity dries up, everything stops moving. Credit is the oxygen of modern finance. Without it, the system suffocates. Now the regulators are pretending they can manage this. They're raising margin requirements on COMEX, forcing longs out of their positions, and trying to keep a lid on prices. It's the same playbook they've used for decades. But the problem now is that the demand for physical metal is overwhelming. You can't suppress something forever when real people, real nations, and real industries need it to survive. The silver market is especially dangerous for them because it's so small. If even a fraction of the money currently flowing into tech stocks or treasuries were to move into silver, the price would skyrocket overnight. Remember, the entire annual global production is only worth about $40 to $50 billion. That's peanuts compared to the trillions sloshing around in financial markets. One large hedge fund or sovereign fund could buy the whole year's supply. That's why the suppression has been so aggressive, because it has to be. But the longer they play this game, the bigger the imbalance grows. And when it breaks, it'll break violently. We're talking about a repricing event where silver could gap from $50 to $200 in a matter of weeks, not months. And once that happens, gold will follow. When the monetary metals reprice, it's not just a chart pattern, it's the end of an era. Let's talk about what happens when that system finally cracks. The derivatives losses will be staggering. Because remember, these contracts are zero-sum games. If someone wins big, someone else loses big. And if that loss is large enough to wipe out a counterparty, then no one gets paid. The winners become losers, the losers go bankrupt, and the chain reaction spreads. You get margin calls, forced liquidations, and a full-blown credit freeze. When credit freezes, interest rates spike because nobody trusts anyone to repay. Mortgages, corporate loans, government debt, it all becomes toxic overnight. Real estate collapses, equity markets crash, and all those safe government bonds become radioactive. You get the kind of contagion we saw in 2008, but on steroids. The Fed and other central banks will respond the only way they know how, by printing. They'll flood the system with liquidity, but this time it won't restore confidence. It'll destroy it. Because people are already waking up to the fact that every new dollar printed makes the existing ones worth less. The more they print, the less people will want to hold paper. That's when you get hyperinflationary psychology, the rush to convert currency into real things. And that's when precious metals go parabolic. Not because they're getting more valuable in real terms, but because the measuring stick, fiat currency, is disintegrating. When confidence in the currency goes, everything that can't be printed explodes higher. Now let's bring this down to a human level. What does this mean for you, for me, for the average person watching this? It means that the things you take for granted, being able to buy food, fill your gas tank, or withdraw cash, are not guaranteed. If the credit system seizes, the supply chains stop. If the banks close, your money becomes inaccessible. The time to prepare is before the panic, not during it. That's why physical silver is not just an investment, it's insurance. It's the bridge between wealth preservation and survival. You don't trade gold for groceries, but you might trade silver for eggs, for fuel, for labor. And when I say silver, I mean small, divisible, recognizable pieces, like junk silver coins or 1-ounce rounds. Those pre-1965 dimes and quarters are going to become the real currency of local exchange when the digital systems go down. People ask me, Bill, what if I can't sell my silver? Well, my answer is, that's the point. You don't want to sell it into a broken market. You want to hold it because it'll be one of the only assets still accepted when everything else fails. We've already seen what happens when physical supply dries up. The wholesalers have pulled their bids, the refiners are overloaded, and the premiums on retail coins are spiking. That's not a sign of weakness. It's a sign of strength. And think about this. Every time someone sells junk silver today, that supply is gone forever. It's melted down, refined, and turned into industrial bars. They're not minting any more 90% silver coins. The supply that exists now is all that will ever exist. As time goes on, that scarcity will become obvious. Those coins will command massive premiums because they're both functional money and historical artifacts of a system that used to be honest.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.